I wouldn't be shocked if they're talking 25 that you see 27. I don't think anyone would fall out of their chair. That's actually been de rigueur.
That's also buzzing around right now, 27.
Yeah, so don't be surprised. But I think they want to leave enough room so that you get a substantial first day. As we know, the optics of that are important, but you don't want to give away too much. You don't want to have it look like a mispriced deal. So 27, 28 seems to be the chatter. And if they're saying 25 now, that would probably make sense.
You know, it's funny. It's like that's so different than when we were at the height of 99, right? In the dot-com boom.
Then it was get whatever you can get.
Even Facebook. I mean, because, if it was priced at 25, people were saying, 50. I mean, so the point is you're only a couple of dollars off of where you're expecting. So you're not expecting huge.
At this number, you're talking about 7.5 times 2015 revenue, at least what they're expecting, but who knows? You contrast that with something like a LinkedIn, which is 11 times, or a Facebook, which is almost 10 times. It makes sense, but I think what investors need to then decide is, will that gap close once it comes public? Is it going to last long at 7 times revenue 2 years out, or are they going to jump all over it and take it up to close that gap with its publicly traded peers?
I'm glad you said that, because 7 times revenue, it seems like a good valuation in your head. I mean, this is Brian Weezer. Brian, you've got a $29 price target on it, right?
Yeah, and we don't really look at it in terms of multiples of revenue, although I would note my tie has hockey sticks on it because you could look at the business as a collection of hockey sticks of growth. But put that aside. No, we've come up with a pretty clear model. We get to about $4 billion of revenue by 2018. We're very comfortable with that number. We can get to about 40% margins, very consistent with the management's own expectations. And you DCF that back, and you can come up with a $29 value or something around that range pretty easily.
It's interesting that you're talking about revenue, you're looking at revenue. This company may not be profitable for a long time. We don't care about that.
Yeah, the business scales. The business scales. I mean, it's no coincidence that our target profit margin, we came up with independent of management. They came up with their numbers in their roadshow after we came up with ours. And I think we're looking at the same source data around Yahoo and Facebook at comparable sizes. And when you look at that, you can see profits in the model. It's pretty clear.
Yeah, hey, Maria, I don't want to be the Grim Reaper here. But, guys, we have to look at what they're actually doing now. I mean, of course, the projections are always important, but in this particular IPO, I'm shocked by the whole thing. When Facebook went out last year, they were 21 times revenue. These guys are going to be between 40 and 44 times revenue. Microsoft was 3 times revenue. Google was 15 times existing revenue. No question we have to look at the projections, but what are these guys doing now? We're looking at a company that's lost about $150 million, and we're putting a $14 billion price tag on it. Give me a break.
That doesn't reflect what is a venture-funded company.
Oh, go ahead,
adjust
Brian.
the value. Look, here's the issue, right? They're going to control the demand. They're controlling the supply a little bit. Their offering's not as big as Facebook, so that's smart of them. But these institutional investors are going to start getting rid of that stock. So it's really the investing public, it's the secondary round that I'm concerned with. Because if you look at this company, the value is way out of whack.
Yeah, so
we cannot live in spreadsheet land. That's the problem. Excel spreadsheets are great little tools, but we got guys in cubes who are doing these projections. We've got to look at what this company is doing today.
And
that's my problem with the dialogue.
Yeah. Yep. It's important
analysis. You should stay away from the stock on that basis.
I agree in theory that we have to look at today, but not today like the trailing 12 months, but kind of where we are this quarter, maybe looking ahead the 4 quarters, and that gets a little bit closer to reasonable. Now, none of these numbers are reasonable if you think about price to earnings ratios versus price to sales ratios, but the real key is there's absolute certainty that some of the institutional investors are going to sell as soon as their lockup expires, and that's going to put pressure on the stock.